All right, hopefully you've watched the last lesson where I talked about bonds premium. Now we are going to talk about interest on a bonds discount. So what are we talking about? We're talking about what do we do with the difference between what we issued the bond and what the bond's actually worth as far as what we're going to have to pay back at maturity. There is going to be a difference. Now in the last lesson, we talked about the premium where our bondholders are paying us more than what the bond's actually worth. So we're going to take some of that and we're going to squish their interest expense just a little bit by paying back their own money that they give into us. In this case here, we're at the opposite situation. So we sold the bonds at a price less than what the bond's really worth. So what's going to happen? Well, we've got this difference and now we're going to have to bake that difference as an additional interest expense over the life of that debt or that bond. And as such, that interest based on face value times stated rate, that's going to be lower than what the actual interest expense is going to be because we have to tack on that difference between what we issued and what they're worth every single period. So it does opposite what a premium does. Now in this lesson, we're going to help you understand that. We're going to show you some pictures and just get you conceptualizing what we're going to be doing here in the later videos. So let's get started here with talking about interest on bonds issued at a discount. So when a bond are issued at a lower price than their face value, the difference between the two is called the discount. How much they're worth versus how much we sold them for. That difference is the discount. Now, the discount is not a loss, so we don't book it as a loss. We book it as a discount on bonds payable, but rather an increase in the cost of borrowing, and as such, increase is the interest cost incurred by the company. So basically, we're going to book that difference as an additional interest expense, but we're not going to pay it yet. We'll pay it when the bond matures. So what are we doing here? Well, let's say that we issue a bond at $98,000 for $50,000, and the bonds are really worth $100,000, which means we're going to have to pay $100,000 when they mature. So we have this difference of about $2,000. It's actually $1,550. So this difference of $1,550, we're going to have to do something with it. What we're going to do is we're going to allocate that difference each period as additional interest expense. So by the time we are done and we're ready to pay back our bond, we have incurred that interest expense over time, and now the carrying value of that bond went from $98,450 to $100,000. Our job is to take that discount or that difference here and allocate it over time so that we get to $100,000. What we don't want is that at the very end, book a interest expense of $1,550. And the reason why we don't want to do that is because that's not properly putting that expense to the time in which it was incurred. When did it occur? It actually incurred over time rather than a point in time. So we're going to amortize the difference as far as an extra interest expense. Now, how does this look like from what we pay versus what we're going to book as an expense? Well, this is what's going to happen here. The amount that we're going to pay in a discount period is going to be less than what we're going to book as an interest expense. So how do we get interest paid? We get interest paid by taking the face value of the note or the bond and multiplying it by its stated interest rate. When we do that, we get the amount of interest that we pay. So we're going to pay that interest to our shareholders, but that is only one component of the interest expense. The difference here, so this difference right here, is us amortizing the discount. So slowly getting rid of that discount so that when we do pay back, we're paying back the full amount that it is due back to the bond holders. So that's what we're doing here with a discount. Our interest paid is going to be less than what we're going to book as interest expense on our books. So there are two ways in which we calculate the amount of the discount that will be increased into interest expense, but not our interest payable. We are going to either use the straight line method or we're going to use the effective interest method. Like we said before in the last lesson, the effective interest method is used usually for long-term bonds because the difference between $1 today and $1 tomorrow is significant when we bring in more time. Straightline we often use for short-term bonds or notes, and the reason why is the difference between using that and the effective interest method is usually immaterial, and so it just makes it easier just to use the straight line. What do we mean by immaterial? It doesn't change the decision-making process of the user to the financial statement. So we're talking maybe about a few bucks versus a few $1,000s on the effective interest method for a long-term bond. So we're going to show you how we do both of these for both a discount and a premium. So that is a look on interest on bonds issued at a discount. Again, it's very much like the premium. The only difference is now we're going to have to make up for that difference that we didn't collect when we first issued those bonds. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.